Welcome to Saving the Investor with certified financial planner, investment advisor, and insurance professional Alfie Townsend, president of Advantage Retirement Group.
What's going on, Bull Sharks? My name is AJ Liuzzi alongside my colleague, Charles Nicholson. We're here today with Alfie
Townsend. That's a tough one.
Alfie Townsend. He is the CEO of...
the Advantage Retirement Group. It's a financial firm here in Southwest Florida.
So we were at the Elite 8 conference. We saw you speak. It was a wonderful speech. You spoke a lot about leadership. Could you maybe reflect on that?
Yeah, well, I always was taught really at a pretty young age. My stepfather, Jack, he always said you have to lead by example. Matter of fact, he worked in the retail side of ladies' shoes and men's shoes. He was a vice president of a big, Florsheim shoe company, which was big. And he, the first thing he would do is when he hired someone, he would have them clean the bathroom. And he did that for a reason. He wanted to let them know that no job is too small for you. So he did that, but he always, I always watched him lead. He wouldn't just tell you what to do. He would just do it, then you would follow. So that I would say makes a good leader.
So we want to move more into the financial side of things. As a retirement financial advisor, what are some of the first steps that young people can take to maybe save more for their retirement?
Well, they have to, really stay focused, I say, because, when you're young, a lot of people, they feel like they have time on their side, so they can, but they don't realize that time is money, because you can start at a younger age and you won't have to put as much in than if you wait 5 years from now, 10 years from now. So the main thing is consistency, to continue to put money in. If you have, even if you have $100, put $10 aside. Put 10%. If you can, put 10% and save 10%, you'll be amazed how you can live on the 90% and still have money saved.
And, for me, it's kind of at a younger age, everybody makes mistakes, right?
Oh,
but what kind of
older age too?
What kind of guidance should you give other than, what you should do with your money? But what are those common mistakes that you're kind of seeing?
Well, the common mistake typically, especially in not just young people, is they don't pay themselves first. You got to pay yourself first. You got to, unless you want to keep working into your 70s and 80s, you want to pay yourself first so you don't have to do that. So that would be the biggest mistake. And then they stop. They'll say, you know what, I'm going to stop putting my money in the 401k, or stop, I'll make it up later. I need this money now. And, it's just hard to make up time. It's hard to make up time. So consistency is the mistake I would say people, make.
So when you are looking to invest young, what happens when it comes along for young adults who are trying to pay off their student loans and trying to get out of debt in some situations?
Yeah, it's tough. You have, your top priorities is what I always emphasize, our clients that are older, obviously, and they're, I tell them, you want to be debt free. So your goal is always to be debt free. And if you're debt free, you're not a slave to the dollar anymore, right? When you got money coming in, you don't have to worry about things. That does make life a lot easier. But you have to prioritize, and you would want to look at your, the higher interest bills first. Okay, so if you have student loans that are 17%. You want to pay those guys down first, and something that's at 6%. So you have to look at the interest and pay that high interest first, pay it down, and then, do the other ones, put more money into the higher interest rate.
And I think this kind of reflects both on the older generation and, of course, our generation, but credit is very important, right? So how important is it for a younger, student to try to start building credit? How can they do that?
Yeah.
Those sorts of things.
I had a coworker of mine that was older. I was like 16 years old, and I went to Gordon's Jewelers in Tampa, and he co-signed for me and got credit, and then I made payments on that piece of jewelry I bought. And then before you know it, you start getting credit cards in the mail, and then I got a Diner's card. They don't have that anymore. Then, the MasterCard, it was called at that time. And then, American Express and so on. So the credit will follow you, but you have to establish it. And then I established it by getting a co-sign, or someone co-signed for me on a card. And then I paid it off. And that's the main thing. They want to see your ability to pay. But credit is very important. And there's good credit and there's bad credit. You don't want to charge things that have 18-20% interest and make minimum payments. That's bad credit. But good credit would be where you're getting a loan for a car, or getting a loan for a house. That's good credit. Or getting a loan for a business. And that's the difference between good credit and bad credit.
One of the other big things kind of transitioning over here, especially now, is stocks investing.
Yeah.
Investing is a really, really big thing. So what is kind of the difference between investing in stocks and bonds, and how can young people get started in investing for their future?
Yeah. So bonds are more for older people. That would be for, let's say, you're trying to create income. So bonds would be a good income source. But as a young person, I would do nothing but equity, which is stocks. I would do the stocks all day. Bonds, the older you get, when you start getting closer to retirement, you would throw bonds into your mix of stocks, and that reduces your risk. It reduces the portfolio because the risk of the portfolio, because if you had just stocks, the market goes down, your accounts are going to go down. But when you have bonds in there, when the stocks go down, typically the bonds will go up because that's a safe haven. So, but I wouldn't, as a young person, even consider any bonds for many, many years into your 50s probably. Just go for growth equity. But the difference is bonds are going to be, bonds are more income producer, where stocks are more growth producer.
And I know that, the younger generation, pretty much everybody can really get tied up in the news and that sort of thing, right? And you're seeing a lot about crypto.
Yeah.
And I just kind of want to hear your point of view on that. What do you kind of foresee? I mean, of course, nobody really knows, but what's your point?
So, to be upfront, crypto, we don't offer it here at our firm. It's a very volatile asset class. Okay. It is, with President Trump, it's getting more and more mainstream. People are starting to look at it more. He's promoting it more. But the thing about crypto, when it first came out, when the Bitcoin first came out, there was, I believe, 20 million coins. And what I was told is there's like 20% that's totally lost that will never come back. And when I say lost, that means the value is gone. They'll never get that back because they lost their password, the chain. Something happened with the chain, so they died. People didn't know where, that they had it. So there's a lot of things about crypto that I don't like. And one of my good friends says, if it doesn't have an 800 number where I can call and complain about it, I don't want anything to do with it. And that's how I sort of look at it also, because, now what made Bitcoin special, why people liked it when it first came out, is that you could buy things that no one knew what you were buying. So that's what that makes, I like that. I like that if I want to buy a boat and don't want anybody to know about it, I could buy it with crypto if they accept it. The problem is now I think it's going to get more and more regulated. And as it gets more and more regulated, then it's going to be just like digital currency at that point. They're going to know everything about it. So I think it will be changing.
And I do want to establish this just before we get any further for those that are listening in, the difference between a bank and what you do. Kind of where the line is, what you focus on compared to banking.
That's a good question. So a bank is more typical, they're going to give you loans. You're going to write checks. It's going to, you do your banking through a bank. Now, back in the early 90s, they made it where the banks were allowed to, before they weren't allowed to invest your money. Okay, they were just there for banking. And then like a Kennedy Castlebaum, I believe it was, passed it where banks can do investments now. So now you're starting to see all the banks do investments. I personally think that, the independents can do a lot better job than a bank, because a bank is limited to what they can offer our clients. So we're not limited to what we can offer because we're independent. We're a registered investment advisor, so we can have different money managers, different strategies that we can use, alternatives, where a bank is pretty much going to be, more of a, we're bankers, but we also do investments also. And I don't like that. And really the CPAs weren't allowed to invest other people's money. And then when that law passed with banks, they were able to invest. And I would never work with a CPA to handle my tax returns if he did investments also, because I think he's double dipping,
right,
or she. And I think you keep those two things separate. So a bank should be one thing and advisors should be another thing. That's my personal opinion. I think independents do a lot better job than what a bank would do.
A lot of the younger generation, we tend to get demotivated at sometimes. How can people really stay motivated when they're looking for a long-term financial goal?
Yeah, well, it's called focus, and they have to not look at the, for example, you have to take the emotion out of investing. We said that you have to take the emotion out of investing. So, it's disheartening when you're looking at your account and look at when COVID came. Okay, that was 2020. It wasn't too long ago. COVID comes, and then the S&P lost 30% in 22 days. Okay, so that was the biggest drop in 22 days in history, more than the Great Depression. Okay, it dropped in 22 days 30%. So some people couldn't take it anymore, took their money out. Well, by the end of the year, it made up that 30%, and it was up like 18-20%. So it made all that up and then some. So you have to look at the long-term goal and not worry about the short term. So when it did drop 30%, that is typically the market comes back roaring. So that is an opportunity because you're getting things at a discount. So you want to be a contrarian, meaning that you want to do the opposite of what most people are doing. Most people are freaking out, putting their money into cash. So they never made that 30% up. They're still down. Okay. What you want to do is leave it alone. And as a matter of fact, if you have that extra money, when it hurts, you want to buy that. It's harder to buy when the market's going down than it going up.
And for the people that are trying to just get started in investing, of course, you kind of have to start somewhere. You have to understand what these different terms and what these different things mean, which, of course, is where, companies like you would come into play for that advising help. But where should somebody start? And I'm not talking money into a market, but kind of learning more about it. What kind of resources do you recommend?
Books. There's a great book that just came out with Anthony Robbins, which is, Tony Robbins has been around for 4 decades, and he coaches, other business owners and motivational speaker. And he has a book called The Holy Grail and of investing. And it's a great book for anybody to really buy. And, willing to give my book to, I have a book, Making Waves in Retirement. It's a financial book. It talks about different types of investing. But, these are things that you really, the more knowledge you have about investing, the better. But, getting started is the main thing when you're young. Time is on your side, and take advantage of that. And just, if you, invest, it would be, just open up a Fidelity account or a Charles Schwab retail account and just buy the index, the S&P index. And that usually wins. You can even be a little bit more aggressive and buy the QQQ, which is the NASDAQ. So split it up in those two and watch what happens to your money, and just be consistent, put money in.
A lot of this can be, very overwhelming for someone who is kind of lost. Do you have any tips or things for someone that may be feeling very overwhelmed in a situation, who's trying to get their feet running?
Yeah. So, the more money you have, you'll be able to hire people down the road. Okay. Because, the older you are, they have the same feelings too. They're overwhelmed by the tax laws. Should I sell? Should I buy? What to do? If you have a plan, you're going to be just fine. Okay. So you'll have a plan down the road when you have money to invest, because your financial advisor will put that plan together for you. But when you're just getting started, or you're feeling overwhelmed, what you want to do is, if you're investing, you're doing something. People that are overwhelmed that's just not doing anything, that are, they're frozen, that's not good. Just make sure you're consistently putting money in. And to keep it simple, I would just do the S&P and the NASDAQ, QQQ, and the S&P 500 index. And what's nice about it is you can put very little money in there and keep buying the index on a consistent basis. They're very inexpensive. They're inexpensive because they're not managed. That means they're just an index fund of 500 companies, 100 companies, and they'll change them around every now and then. But it's hard to beat the S&P. Even if you're paying advisors for it, it's hard to beat the S&P. What we try to do is get you the returns of the S&P with less volatility. That's what we try to do. But that's where I would go. Then you don't have to worry about it.
And can you explain a little bit about splitting up your money, diversification, and where you should kind of go with that? You mentioned those few.
Yeah. So diversification, you don't want everything moving up and down at the same time. Okay. If it's moving up and down at this, like if you had Apple, and let's say you had NVIDIA, they're going to move up and down typically at the same, so what you want to do is you might want to have a Apple, and you might want to have a Procter & Gamble, with GE or something, things that aren't not going to be moving exactly the same. Now, that's where I had said earlier about bonds. You would have bonds, because if the market's going down, people are going to put money in bonds, and that will go up. So that will keep your volatility. But at a young age, you want to be more growth oriented and not have any bonds. But diversification is very important. When you're buying the S&P, even though you have 500 companies, it's not really diversified, because they're all going to go up and down at the same time. Okay, so how you would diversify them is to buy some international companies, international stocks, to buy some small cap stocks, some smaller companies. So that will change up that will make it more diversified and not be as volatile. The allocation is one of the most important part of a diversified portfolio, is how it's allocated, not having everything the same. So the S&P is large cap stocks. So they pretty much follow each other when the S&P goes down. So you would want something you can have like alternatives, which you can have structured notes. These are things for income. They have some protected buffers in there. You can have like the S&P with a 20% protected downside. So if the market goes down, you're protected. But instead of making the unlimited upside, it might put a limit of 15% on there.
So I want to kind of circle back to the whole investing side of things. Social media is a really big influence on a lot of the younger generation, obviously. I want to kind of grasp your thoughts on day trading. I know a lot of people that make their living off of day trading. What are your kind of thoughts on that? And is it good for younger people to start in day trading to maybe gain a little bit more capital?
It's if you want to lose a lot of capital, day trading is very good now because it's very risky. Okay, so day trading means that you're buying something today and maybe at 3:30 before the market closes at 4, it's up about $1, so you're going to sell it. So, you can make money in the market going up or down. You can short the market thinking that, hey, the market's going to go down today, so you can say, I'm going to short the market. So you can short it or you can play it long, which would be increase. Day trading is very difficult. I would leave that to the pros. They have charts. That's something you would go and study. And before you put a dime in, you would really take classes on it, what to look for. Your charting, meaning charting a stock where it looks like it's going to go. That's a whole science in itself. So what I would do is I would really play with monopoly money first before you would take a venture like that.
And for me, I'm scrolling on social media. I follow a few accounts that show different how the market did for the week or for the day or that sort of thing. But then you have some ones that maybe spread false information. How can you make sure that you're doing the right thing?
Well, just remember, when you're watching the news and when you're watching these programs, a lot of times they're telling you things that they want to drive the market. They might be telling you this stock is good because they might own it. This person that's on this MSNBC might own this, or the Fox business. They might own that stock. So they're saying, hey, I like Amazon. Amazon's, the orders are up. They're expanding this, they're expanding that. So they're trying to drive that's old news. What you're hearing now is all old news. So that's not what drives the market. What drives the market is things that you don't know, like the earnings that comes out the next morning that you don't know what they're going to say, up or down. And if it's down, then that market goes down, but you didn't know if it's up or down. So if you knew what the market was going to do, it wouldn't be efficient. So that's what makes the returns of the stock market is the uncertainty. But there are ways to work around, things to get that extra return, but it's not listening to the guys on TV or podcasts.
Another big thing is financial literacy. What role does it really play in when you're making decisions about your money?
Well, what I always say is you have to make sure, just make sure that the investment's a solid investment. So, even my mom, she didn't really know a lot about investing, and I helped her out along the way with, helping her out with, getting her a house and a car and everything. But she made sense when she said, I only like to buy stocks that I deal in. Like she liked Starbucks, so she bought Starbucks. I used to ride Harley, so I bought Harley stock. So things that you're familiar with is if you're going to buy individual stocks, that's a good way to do. If there's like if you like the trends on clothes, like hey, I like Lululemon. They're always having cool clothes out there. Then you buy that. You buy things that you like. and because you see the trend, okay, and then you're gonna, the technology with AI and everything, that's going to be the future, I think, for the next quite a few years is going to be that. And there's different levels of AI, and we're just starting to scratch the surface right now.
And I think you kind of know my next question is your take on AI. How, does it play into this investing world? Does it play into kind of what people are thinking, what they should be doing?
So what it does is that I was told by analysts, that's called chartered financial analysts and CFAs, and what they can put in AI and get so much more information in such a short time that it would take hours and hours, and they could do it in seconds to get the numbers what they need. So that's where AI is going to help a lot. Now, where AI is not going to help is they tried AI with the robo advisor. Remember the robo advisor? Oh, it's going to eliminate financial advisors. Mm-hmm. Well, you don't even see them anymore. They're not even around anymore, the robo advisors, because people want human face to face. They want to be able to see their person and talk to them and ask them questions and know they're talking to a human. But there's going to be a role that AI plays, and it's going to be more of the analytical is because they can dissect information faster than we can by thousands and thousands of times. Okay, so that's going to be a good thing. It will help build portfolios, and it will help check out companies if you want them in that portfolio or not.
Another thing with the AI is how effective is it? Because it could help build a portfolio, but in some cases, if it ever fails, how would that affect the industry?
Well, the portfolios that they build, they are all going to have, I don't care if a human's building it or AI's building it, you're always going to have up and downs. So, just because AI is building it doesn't mean it's not going to fail. It could fail just as easy. So where AI would be a problem is where they're good is they're taking the emotion out of it. Okay, that's a good thing. They're taking the emotion out of it. But where it's bad is that they might overreact on something more than they should, or stay in there longer than they should. So it's going to be something. I think it's going to be more of a building the portfolios, doing the research on the companies that's going in there, and they can do that a whole lot faster than we can do it.
Tax season is here, right around the corner.
Thanks a lot.
Where does the investments come into taxes? You have to file that. Where's all that kind of come in?
So, every investment brings different types of taxes. You have long-term capital gains, which if, we're building a portfolio and we're selling some of those holdings because we're rebalancing, that could create a tax for our clients. And that tax would be, hopefully the best tax is a long-term cap gains. That means we held it more than a year, and it's taxed at a lower rate than ordinary income. So short-term cap gains is between owning that asset between now and 1 year. And if you sold it, and if you're in a 30% tax bracket, that stock is ordinary income at 30%. But if it's over a year, then it's taxed at long-term cap gains, which is a lot of times at 15%. So your long-term cap gains is your best one to have. Ordinary income would be, you're making income or you're selling something before or holding it, before a year. That's ordinary income. So we got to be, we have to look at everything that we're doing and make sure that we're not creating unnecessary taxes for our clients. If it's IRA money, you can buy and sell all day in that. If you're not taking it out, you don't have to pay any taxes on that money.
And I do have one more before we kind of wrap up here is, kind of tell me your story. How did we get into this sort of company?
Yeah.
You know, did you know you wanted to do this? Did you invest early on?
Yeah, no, I didn't invest early on. I was, you know, at a young age, I really didn't know what I wanted to do. That was, you know, it was like a lot of kids, you know, in their, early years. I came into this business by, accident, really, because I didn't know what I wanted to do. And then it turned out to be what I wanted to do, help people. But my mom changed careers from retail. She was in the retail side of, you know, things for her whole life. And then she answered an ad for insurance, and I helped her pass her test. I was reading her the questions at 19, and she was, you know, my mom was very young. She was like 37, I guess, at the time. 40 or so. And so I helped her pass her test, and I saw that she liked the insurance business. And then I ended up, I didn't know what I wanted to do. So I said, well, let me get my license. And that's how I did it. At 21 years old, I got my license, and then she got out of it. And then it evolved around later on to get into more of the financial side of it. Got my CFP, and but it was an accident. I wasn't saying I'm going to be in the financial business. I didn't know what I wanted to be. I invented a beach towel at 19, had a patent on it, had a hidden pocket in it. I had a patent, on it from Miami, and I tried to market that, but that was before the internet. That was before home shopping network, so it was very hard to do. But people always said, you're going to be a millionaire, because they loved it. It was a hidden pocket in there. You couldn't see it. You could hide your keys and everything in there.
Beautiful.
So, but the patent expired, and the rest is history.
So I kind of have one more question here before we wrap up. A lot of young people, a lot of kids in high school, they're starting to make their decision for their future. What role do you think college plays in someone's future? Do you think it's a necessity, or do you think that a lot of people can be successful without going to college?
All right. So I will tell you this. I went one semester of college, one semester. And, but, college wasn't for me. Okay. Now I ended up going back, to get my CFP, which is a certified financial planner, professional. And that's a designation that now you need a 4-year degree, and it's equivalent of a master's. Okay. So, but I did not go to college. Now, so you don't have to, but I have drive, that as long as you have drive and you love what you're doing, you're going to be just fine. You can make a good living. Okay. What college does, I feel that, if I had, maybe I would have went in something different. I might not have made the career choice that I have now. But I do wish I did go to college. That's in the back of my mind. Well, because you look at everybody who went to college, they have good friends, from their fraternity and all that. And so I feel like I missed that. But then on the other hand, I wanted the work. We never had money, and I needed the work to make money. But you can do both ways. You can make it in. Don't use not having college as an excuse that you're not going to make it. Because, a lot of people make money, a lot of money, without going to college. And there's a lot of people that makes money going to college. So you can do it both ways. It's just probably a little harder to do it not going to college, because you're going to have to prove yourself.
Alfie, I appreciate your time. Thank you.
Got it. I appreciate this opportunity.
Ladies and gentlemen, once again, my name is AJ Liuzzi, alongside Charles Nicholson and alongside Alfie Townsend. We will see you next time on the BBN News Podcast. Thank you.